A very good afternoon, guys. Continuing with FM, now we take the next chapter, that is capital structure. In the old syllabus, it was a combination of two, capital structure and cost of capital. In the year 1819, they removed cost of capital, and cost of capital, if you all recollect, it was shifted to FIBAF and there it is being transferred. So now you have only capital structure. Now there is a lot of confusion regarding what should be coming in this, but I have made it very simple, and considering what the majority authors have done, I have made my own sheet and sums according to that. Okay, there is one author, I don't know name, he has kept majority of the sums of cost of capital, which is not in the syllabus. It is there in the syllabus of BAF, but not in TYBAF, it is in FIBAF. So anyway, let's start with the next chapter, that is capital structure. One of a very interesting and very simple chapter. Now before we get into that, first, what do you exactly mean by capital structure? Today if I am running a business or if I am a company, I need money. You all know there are many sources of financing. Equity shares is a very common source. Every company has to issue shares. Then if you need money, you can issue preference shares, you can issue debentures, you can take term loans from financial institutions, you can take bank loan also. So capital structure means what is the structure of the capital component what you are using. Now say for example, company has total 50 lakh rupees being used in the form of financing. Now say for example, out of that 50 lakhs, 30 lakhs is equity, 20 is preference shares. So the capital structure is out of 50, 30 is equity, 20 is preference shares. Suppose company has 1 crore rupee in the business. 1 crore may say 50 lakh they have issued equity shares, 20 lakh they have issued preference shares, 30 lakh ka they have bank loan. So their capital structure is out of 1 crore, 50 lakh equity, 20 lakh preference, 30 lakh bank loan. In short, capital structure is nothing but the breakup of the source of financing what you are using. Okay, now the emphasis here on at least the starting of the majorities on what you are going to do. If it is a total new company, they will give you options, and if it's an existing company, they will give you their existing capital structure. They will plan for additional raising of finance. Say for example, the company has already issued equity shares of say 1 crore rupees. They want another 50 lakhs. So you will be given option that the company wants to raise additional 50 lakhs. They will give you option. One option is raise full equity shares. One option is raise full preference shares. One option is raise the entire amount in the form of bank loan, or they'll give you options, partly equity, partly bank, partly equity, partly preference. So you have to suggest the company which option will be the best for the company so that their profitability will be higher. So that is going to be the concept on the first half of this chapter, where the majority of the sums will be based. Of course, there will be few different type of sums, but initially 2 to 3 classes will be covering around 8 to 9 sums of what I told you right now. So in short, capital structure means whatever finance, whatever is your capital employed in the business, what is the breakup of that capital? How much is your own funds? How much is your borrowed funds? Out of that own funds, how much is equity share capital? How much is preference share? Also, you will be using your reserves for the purpose of business. So that is the meaning of capital structure. Breakup of your finance. You will be asked for a suggestion that the company wants to go for expansion. They want to raise additional money. They will give you options. You have to tell them what is the best possible option. There are other parts also in this chapter, but I am going step by step. The theory what I discuss right now with you is for the initial sums, what we are going to do for 2 to 3 classes or maybe 4 classes. Okay? Not wasting further time. Let's straight away get into the sums. See the question sheet what you have. Come to the practical part. Question number 8. Come to the practical part. Question number 8. Okay? Let's see. MC Limited planning an expansion program which will require rupees 30 crores, and their financing option is given. They have three different options. A part, issue further equity shares of 100 each at par. Then what they say, raise loan at 15% interest and issue 15 preference shares at 12%. So they want 30 crores additional. Three options given, either issue equity shares or take a loan of 10% interest or issue preference shares where the rate of dividend will be 12%. Now see, the present paid up capital is 60 crores. That means the company is already using 60 crores. When I say paid up capital, that means equity share capital of 60 crores. Okay. Then what they say? And average annual EBIT of 12 crores. EBIT means earnings before interest and tax, or you call it as profit before interest and tax. Assume income tax 50%. After the expansion, EBIT is expected to be 15 crore per annum. So currently, they are earning 12 crores in the form of earnings before interest and tax. After expansion, that 12 crore will become 15 crores. So since we are planning post expansion, right now we won't be, in fact for the entire sum, we have to ignore that 12 crores cut digit and we are just concerned with 15 crores. Okay. Further, let's see what it says. Calculate EPS under the firm's financing options, indicating the alternative giving the highest return to equity shareholders. You have to calculate EPS. What will happen? Your decision will be based on EPS, and EPS has to be found out separately for each of the plans. Okay, now see, you will have to make statement of EPS in each and every sum of this type. Now before we make a statement of EPS, we will make one more statement which many authors avoid. Now I prefer it because if you make that statement, it will take 2 to 3 minutes extra. If you make that statement now, the second statement ka calculation towards the end becomes very simple. And that statement will be statement of capital structure. Okay, so starting with the sum, we will split it in two tables. Give the heading statement of capital structure. Statement of capital structure. Now see, you have existing plan and 3 new options. So what you will do, existing is applicable under all the 3 options. You will make 3 columns, particulars, plan A, plan B, and plan C. And the amount is in crores, so write rupees in crores. Okay, particulars, plan A, plan B, plan C. Length will be of around 7-8 lines. Particulars, and there are 3 plans, so plan A, plan B, plan C. This statement will make the second statement end part very simple for you. Just understand the concept. I'm sure you will find this part very, very simple. Okay, now listen. Starting I told you, capital structure means nothing but breakup of the finance what you are using. Now first see, does the company have any existing capital structure? Yes, if you see, they have mentioned the existing, see below the point number C, the present paid up capital is 60 crores. Now when they say capital for a company, capital is in 2 parts, equity and preference. If nothing is mentioned, it has to be always equity. So what we'll do, first write existing equity share capital, or you can also write present equity share capital or paid up share capital. Existing equity share capital. Now listen, existing, already you are using 60 crores in the form of equity share. Now listen, whether you go for plan A, whether you go for plan B, whether you go for plan C, 60 crores is existing which you are already having. So that 60 will come in all the three columns. Remember, amount is in crores. I have already written on the top. Okay, so that 60 will be there in all the three cases. Now we will go plan wise. 60 already I am using. For expansion purpose, I need another 30 crores. For expansion purpose, I need another 30 crores. Options are given three. What is the first option? See the A part. Issue equity shares of 100 each at par. That means new equity shares, so write there. New equity share capital, or you can just say new equity shares. How much? 30. Now under plan A, you are planning for full 30 crores in the form of equity shares. So equity shares is there only in plan A. Getting it? Next, plan B. What it says? 15% interest ka raise a loan. So what do you do? Write there. 15% loan. 15% loan. Now see, loan is in the second option. So it is not in A, not in C. So loan is coming only in the second option, that is 30. And what is the last thing? 12% preference shares. So write there. 12% preference share capital. That is the third option. So it will come in plan C. It's always advisable to make this statement. You can do the next table without this, but you will only say it's always better to prepare this. Okay? Now check the totals. Total for all the three columns has to be the same. If you see 60 is already there and 30 is there in each of the column. So my total is 90 crores. That means I'm already using 60 crores. Additional 30 crores I'll be raising for sure. How to raise? I have three options: either full equity, either full bank loan, either full preference shares. Which option to select? That conclusion will come after we make the second table. Got it? Now in the second table, they have mentioned you have to calculate EPS. Even if they don't mention, we have to do that only. So my second table, column will be the same. Heading will be statement of earnings per share. Same columns, length make it around 10 lines, 10 to 12 lines. Again the same thing, your amounts are in crores only. Plan A, plan B, plan C. Plan A, plan B, plan C. When I do this, you will reconnect some part of your F5 also. Similar calculations we have done in F5 also in the chapter leverages. Leverages was also earlier Tybaf chapter, which was later on shifted to F5. 2018-19 say the syllabus of BAF became a pure qualitative syllabus. Okay guys, so now we are going to calculate EPS, that is my earnings per share. Now listen, whichever plan you go for, your expected profit has to be the same. There will be a difference in cost, but expected profit will be same, because ultimately I am using 30 crores with some expansion plan. So wherever I use that 30 crores, the revenue what I am going to get is going to be the same. So here they have given us EBIT, that is earnings before interest and tax. Now as I told you, they have given you existing 12 crores. That means by using 60 crores, you are generating EBIT of 12 crores. Now what I have to decide is, how will I raise this extra 30 crores? So the EBIT what I will consider will be that where I will be using this 30 crores also. So in short, 12 crores has to be ignored and 15 crores ka revised EBIT has to be considered. Okay, so EBIT, earnings before interest and tax, 15 crores in all the three plans. Okay, amount is in crores. Of course, EPS will be per share, rest all the amount are in crores. You all have done this statement in FI BAP. You all have calculated EPS also in FI BAP while doing leverages. Now listen, earnings before interest and tax. Now when I say before interest and tax, it means first I'll have to deduct interest. Remember, when you pay interest, interest is an allowable expense for income tax purpose. So my next step is, after writing EBIT, I will deduct interest. After writing EBIT, I will deduct interest. Now listen very carefully. Basic, you all know. On share capital, we pay dividend. On share capital, let it be equity or preference, we pay dividend. Interest is paid only on borrowed funds. Now see, where is borrowed funds? See the advantage of making this statement. Can I say this is my borrowed funds? No interest on share, no interest on new share, no interest on preferences. 15% loan. Where is loan? Only in B part. That means interest won't be there in plan A. Interest won't be there in plan C. How much you have raised? 30 crores. What is the rate of interest? 15. So my interest, you can write next line in brackets, 30 into 15%. That will give you 45, that is 4.5. Getting it? Interest will come into picture only when there is loan. Share capital pay, there is dividend. Got it? Now, take the difference. Plan A will be 15, plan C will be 15, 15 minus 4.5, plan B may, it will be 10 rupee 50 paisa. Plan B may 10 rupee 50 paisa. Now see, basic. What was the thing you had written? What was the word written here? Earnings before interest and tax. Now I deducted interest. So interest is already deducted. So now against this, what I'll write is earnings before tax. EBIT less interest will give you EBT. Earnings before tax. This is all basic what I have done in FY. Now, from this, I will deduct income tax. See the rate of income tax given, how much it is? 50%. So, less income tax at the rate of 50%. Now remember, whenever income tax is given in terms of percentage, it is always percentage of EBT. So when I say income tax rate is 50%, it is 50% of EBT. So 15 ka 50%, 7.5, 10.5 ka 50%, 5.25, and again 7.5. So take the difference, that will be your earnings after tax. Okay, from before tax, deduct tax, that will be your earnings after tax. So 7.50, 5.25, and again 7.50. Okay, 7.50, 5.25, 7.50. Now listen, I want EPS. When I say EPS, earnings per share, it is that earnings which is available for the shareholders, but equity. Equity shareholders are the final people who actually own the company. Preference may be there, provided they are participating, but that is not there in this chapter. So what happens? Before I find out what is my earnings for the equity shareholder, if there is something which is payable to the preference shareholders, that I will have to deduct. So what I will do, from earning after tax, I will deduct preference dividend. Now remember, the reason for deducting interest on the top, then tax, and then preference dividend is, you all know that very well. When you pay dividend, it is not an allowable income tax expense. Interest is an allowable income tax expense. Therefore, we deduct interest, then we deduct tax, and then preference dividend. Now we know very well, preference dividend will come into picture only when there is preference share capital. See, which plan may there is preference share capital? Plan C. So no preference dividend in plan A, plan B. C may. How much is the amount? 30 crores. What is the rate of dividend? 12%. So 30 ka 12% gives you 3.6. 30 ka 12% gives you 3.6. Now take the difference. Plan A 7.5 remains same. Plan B remains same. 7.5 minus 3.6 gives you 3.90. Got it? Interest will come only where there is loan. Preference dividend will come only when there is preference share capital. Earnings after tax minus preference dividend. Whatever was payable to the preference shareholders in the form of dividend, I have deducted. So now, see, this was payable to the people from whom we borrowed money. This is paid to the preference shareholder. So now, whatever remains belongs to the ultimate owners of the company, that is equity shareholders. So against this, you will write earnings for equity shareholder, or you can write earnings available for equity shareholders. This is my earnings for, or you can say earnings available for equity shareholders. Clear, guys? And now, what is the heading? Statement of earnings per share, EPS. Earnings per share. So what I'll do, this is my total earning. Remember, this is in crores. So if I want earning per share, this I will divide by the total number of equity shares. This I will divide by the total number of equity shares. Now listen, again an advantage of making that statement. See, now you have to see, when I say equity shares, remember, there is existing equity share capital as well as there is new. Now see, this is share capital ka amount. What I want here is number of equity shares. Now question has to give you the face value. See the question, what is the face value? See the starting ka line. 30 crores, see this, plan A mein. New equity shares 100 each at par. Nothing mentioned. Face value of old and new has to be the same. Now see, plan A equity 60 plus 30, 90 crores. I have to take both old and new. Plan B only 60. Plan C also only 60. Now this is in crores. I have to divide it by the number of shares. So what we'll do, I'll put it in brackets. See, first case mein 60 plus 30, 90 crores. Each share is of 100 each. So I divide by 100. Plan B, 60 divided by 100. Plan C, 60 divided by 100. Because here it is in rupees in crores. So my number of shares also has to be in crores. So now do 90 divided by 100. 0.90. 60 divided by 100. 0.60 and 0.60. Getting it, guys? Clear? I repeat again. That is 60 and 30. 90 crores. I want number of shares which has to be in crores. So I divide by 100. So this is 0.90 crores, or you can say 90 lakhs. Divide, get the answer. That will be your EPS. Earnings per share. So 7.5 divided by 0.9 will give you 8.33. 5.25 divided by 0.6. 8.75. 3.9 divided by 6 will give you 6.50. 8.33, 8.75 and 6.50. Clear, guys? So per share, if I opt for plan A, I'll be earning 8 rupee 33 paise per share. If I opt for plan B, I'll be earning 8 rupee 75 paise per share. If I opt for plan C, I'll be earning 6 rupee 50 paise per share. See, I'm telling you something which is not in the syllabus, but very important for practical life. In future, when you all work in corporates, very important. Where the EPS is highest? Plan B. So we got the conclusion. We'll be opting for plan B, where we will raise this 30 crores in the form of loan. Now see one logic, why it is higher. I am paying 15% interest here, and here I am paying 12% dividend. But remember, when I am paying interest now, I am getting benefit of income tax. So what happens? You all have done this earlier in FI. 15% is my loan, 12% is the cost of preference shares. Now for preference dividend, I don't get benefit of income tax. Now what is my tax rate? 50%. So 15 ka half is 7.5. So here my cost of fund is 7.5. Here I don't get tax benefit. So here my cost of funds is 12. That is the reason earnings for equity shareholder here it is less. The reason is I couldn't take the benefit of tax. I have taken the benefit of tax, but not for dividend and interest. And here if you see, I saved 4.5 crores here because of payment of interest. So that is the reason in majority of the cases you will see where there is component of debt, there the EPS will be higher. But it is not advisable always to have component of debt. The reason is if you have your own funds in the form of equity shares, try to reduce debt as much as possible. But there is something called as trading on equity. That is nothing but taking advantage of tax benefit of interest. What that concept says, try to, even if you have your own money, it is always feasible to have some portion of money in the form of debt to take advantage of tax. That is the reason. Even if you see in practical life now, some people, even if they have money, when they buy a property, they will take some part of money as a loan, housing loan. The reason is because when you take a housing loan, your SY-BAFCA tax, you get a deduction under ATC. So ATC may you get extra tax benefit. So sometimes even if you have your own money, people take loan so that they take the advantage of tax. Same thing is applicable. Got it, guys? So now the conclusion. Where is the EPS highest? Can be. So now when I want 30 crores, I will tell them the best option is go for loan so that your shareholders will benefit to the maximum extent. Okay. Just write down conclusion in 1 or 2 lines. Okay. Since the earnings per share is highest in plan B, since the earnings per share is highest in plan B, it is advisable to raise additional 30 crores. It is advisable to raise additional 30 crores in the form of 15% loan. It is advisable to raise additional 30 crores in the form of 15% loan. Clear, guys? So this was the basic concept of capital structure. In the boards, sums have come of 15 marks. Of course, there was one sum which we'll be doing in next 2 to 3 classes. Right? The very nice sum, just one information was twisted, and you have to go a little bit backwards. How to do that, we'll see when we come to that particular sum. Okay, guys. Now, this being the first class, little bit of theory explanation was there in the starting. So I'm winding up this video, and in the next video, I'll be taking 2 sums. Okay, I'll just be back.